So Emma, we've opened it up. I can't see any attendees in just yet. In fact, we have one just arrived in, so that's good.
Brilliant. Yeah,
So
normally takes us, I think, a few minutes for everyone to link.
Absolutely. We'll give people a few minutes. Now, I can't see the name of the person that's attended, and I guess they will be on mute. So, but whoever it is, you're very welcome. Thanks for joining us. We're going to give it a minute or two to let somebody else has just joined in now, which is good. So welcome. We'll give it a minute more before we kick off. So we've got Peter and Simon. So welcome, Peter. Welcome, Simon. Good to have you on this afternoon. We'll just give it another minute and see if anybody else is going to join us. We've had about, I think we've had about nine or 10 people who've registered initially with the placeholder that I sent out, and then I sent out a further note with the link to register, pre-register. So obviously people have seen that because we've seen some registrations come through. I guess there might be one. Sorry, Emma, go on.
Fantastic. And we're recording, aren't we? So it means.
Yeah, and I think what does happen is some people will register to attend and then maybe can't make it, but they'll register because they know that then get the webinar recording sent over to them. Yeah. So look, we've got 3 people that have joined in now. So
brilliant.
So Jamie's just joined us. Hello, Jamie. Welcome aboard. You should be on mute actually, so you can't respond. We'll open this up for questions a little bit later on, and I think you'll be able to post questions in the chat. In fact, I think we do have a chat. Let's have a quick look at that. Oh, it's Pete saying hello to everyone. Well done, Pete. Thanks for that. So yeah, if you click on the chat, you can make some comments in there. And we've got Amanda, who you can't see, who's supporting us here, kind of managing it in the background. But listen, I think we'll kick off now. We've got 4 attendees in now, which is good. So I think, Emma, if we kick off, if I can just welcome everybody to this webinar that's been presented by A4G. We've been working with A4G, or franchisees, some franchisees have been working with A4G for some time now. They do represent a couple of franchisees from an accounting point of view. And I know they've done some really good work with a prospective franchisee who's looking to buy one of our existing businesses that's up for sale. The thing that makes me really happy about that is that the valuation that A4G came up with was very much in line with any kind of valuation we came up with. So we were quite pleased about that. So that was really good news. But Emma, who's going to be running the session this afternoon for us, is a partner, senior partner at A4G. She's going to be talking through how to build value in your business. Hayley's with me in the office this afternoon. We'll open it up for questions at the end of the session, and hopefully you'll find it very informative. We will record this and we'll make it available afterwards. So I guess without further ado, I'll hand over to you, Emma.
Fantastic. Well, thank you so much to you and Hayley for having me. As you know, this is something I'm quite passionate about, is helping businesses to kind of get their finances in order. And I guess for it to make sense. So that is one of the roles I do at A4G. So I'm one of the partners and I manage one of the biggest bases in the office. And I work with a lot of growing businesses, right from sort of startup all the way through to multi-million pound turnover businesses. And the beauty of it is I really get to see how, you know, businesses can evolve and improve what they're doing and use some of the technologies available just to make, you know, the finances that I think people traditionally expect are for accountants at the end of the year, actually help them run their business a little bit more efficiently. So I've been at A4G now for 22 years. I'm probably older than, been there longer than most of the furniture, but it's always changing. So a little bit about us and the team. So A4G stands for Accountants for Growth, because we are very passionate about helping businesses grow. We're based in Kent, but we work nationally. And I think particularly, you know, with things like webinars, Zooms, you know, it does make that so much easier and you still get to have that personal relationship. We are dedicated to owner managed businesses because, you know, that's what we're passionate about helping, because we do appreciate how that impacts not just the owner managers, but the lives of their family and friends. And really what we look to do is go beyond sort of what you would consider a traditional accountant and really provide a lot of advice, support and planning on how to evolve and improve what you're doing. It's not just a case of, oh, well, we just take what you've got and put it into numbers. So this is a topic that I'm very passionate about at the moment. And we work on like a two-man approach. So although there's 75 in the team, we have 2 people dedicated to each client. So you still get that personal relationship that you build. And it means we get to know the business and know how it works. So as Mike said, we're going to have some question and answers at the end. So if you pop them in the box as you think of them, feel free, and we'll just have quite an open discussion at the end for anything that you feel like you need advice with. So I'm here today to talk to you about building value in your business, because it's certainly something that I think particularly the last 2 years has helped focus the attention of a lot of business owners on, you know, what should I be doing? And, you know, people treat their businesses like a pension fund, but sometimes don't necessarily know how to turn that into value. So I'm going to talk about the best practices to run your finances, the power of monthly management information and what that is, you know, what should you be looking at, and potentially, you know, in the future, making your business less dependent on you. So depending on the stage you're at. So really, finances is all about setting some really good daily, weekly, monthly habits to keep on top of your finances, because I think the minute you don't have those regular habits, it becomes a big job, and it gets behind, and it means you lose sight and transparency about what's going on in your business. So I thought I'd put together just a bit of an introduction, some of my kind of recommended daily routine. So obviously, you know, log in potential customer data. If anyone's ringing or contacting you, I know it's really key for you to make sure that you get those details so that they're on all future mailing lists. So I think that's probably something you will do as standard, but it's definitely worth mentioning because you don't want any of those potential client details being lost on post-it notes. Obviously raising quotes as timely as you can. So it's good to set aside a bit of time every day just to get your quotes out. Raising sales invoices. Now, the reason for that is obviously the quicker they're raised, the quicker you're likely to get payment, but also if for any reason there was any extras, it'll all be fresh in your mind. So you won't miss out on any of those alterations that might have been needed. And then matching your money in from customers to the invoices. Again, you tend to know when people are paying you. And if you're doing that little and often, it means your system is up to date for purposes of credit control. So you just got a really clear sight of what's owed to you still. And then purchase invoice approvals. Again, you know, if it's a couple of days, it's a really light job to do. And get them all on the system along with processing your purchase invoices. So really, I think this is about the habits of using your accounting system to run your business rather than necessarily a filing system. It just makes it a little bit easier. And then you can look at weekly routines. So I know initially when people get into business, they end up making little payments all the time. Obviously, at the point you can get some credit with suppliers and things, having a regular set payment run is a really, really good idea. It just reduces the amount of touches, along with looking at your bank. You know, the less transactions you have to match and try and remember what they are, the better. And also, I'm sure you probably do this automatically, but you're considering your stock ordering and your work scheduling once a week. So, you know, for me, I mean, you might have an idea of when you like to do it, but, you know, a Thursday for the week ahead gives you Friday to sort of deal with any problems that you might be aware of rather than last thing on a Friday. So it's about setting aside some critical time in your business where you're focused on the finances without it taking up too much time, because I think the minute it becomes a 2-3 hour job, that's much harder to fit in your diary. And it also means that if you've got staff working for you, that you can have some rules with them about, you know, when you're not to be disturbed and just small little periods where you need to focus. And then your sort of petty cash reconciliations and your outstanding invoice chases. Now, in my experience, chasing your debtors is just not a fun job. I appreciate that, and is often the thing that is put off for later, but that can then lead to bigger problems. So just having a little bit of time every week to monitor who's missed their payment dates for any reason and make those calls is absolutely critical. And then we have your monthly routines. So that'd be running your payroll. So that, depending on whether you run the payroll, you provide it to someone else. Obviously, you have to send them the data. Getting those payroll journals into your accounting system, because you will be spending a reasonable amount of money on people's wages if you're employing people, and that's critical data to have in your accounting system for you to be able to check profitability. Then you tend to get things through like supplier statements. Now, I think a lot of businesses don't necessarily know what to do with supplier statements. I would always recommend just doing a double check of those onto your system, because then if you've got missing invoices, you ask for them in advance. It shows your supplier you're managing your finances, and you wouldn't deliberately miss payment. And it avoids that sudden call about you owe this invoice that you weren't aware was outstanding. Things like credit card statements tend to only come through once a month, so that's why it's on the monthly list. And then obviously you've got stock takes and stock adjustments. Now, they are really important for your month-end routine to make sure that you're aware of your levels of stock and how to adjust your management accounts, which I'm going to talk to you about later. But for you to have accurate financials, we need to be getting into habits about stock takes. And then, as I said, the overdue debts, that's another, that's definitely not a nice task to do. And you want to be somewhere quiet, so you want to have no distractions and just get those out of the way. So quite often they're early in the week, so that you've won a few battles for the rest of it. So it's just to give you an idea how you can break things down between weekly, monthly and daily, and just to try and generate some ideas about habits with finance, because I know most people say to me, oh, like I hate finance, probably a bit like I hate car maintenance, but we know it's essential. And this is just my way of trying to share with you how to make it a little bit more palatable. So with growing a business and being the business owner, obviously your time is very, very precious, and using cloud accounting software has a big advantage to helping you streamline the processes for finances. It also means you can access information anytime, anywhere. So with a lot of the cloud systems, you can link PDFs to the purchase invoices, which means should you get a call from a supplier or a customer, it's all on an app on your phone. You've also got your debtors on the app that you can manage. So if you get a bit of downtime, gives you an opportunity to have a look at that type of thing. And you can store other bits on there as well, like your insurance policies. So again, it just on the go information, and you can collaborate with your advisors, which means it's just really easy for the key people involved in running your business to have conversations about live data. Now, our preferred software is Xero, and the reason I love Xero is because of the way they automate a lot of things. So, for example, if you take reconciling your sales every day without a software that links through a bank feed, so you can link a bank feed that updates every night and brings in the transactions from the day before. Now, the advantage of that is you're not having to log into a bank app, work out what your transactions were, and manually enter them onto the system, and then try and match them off. With this type of software, the bank feed comes in, it will say, oh, Bob paid £500, we think he was paying this invoice. And then you're just doing a sense check to say, yes, that was Bob's invoice that he paid, tick, it's reconciled, and your debtors list is up to date. So the idea with the cloud accounting is really about efficiency and maximising use of your time.
Emma, can I ask a question there? Does it matter what bank you're with then? Does every bank account have the ability to feed into something
Most
like
banks
Xero?
now have direct feeds. Yeah, they were they had rules about when they were meant to have open source information to be able to do that. Some of them missed the first deadline, and you had to have a bit of bridging kind of software link, which, but yeah, this is what they're all working towards now. But you can, even if you can't do that, you can upload a CSV, so it avoids any form of manual entry.
Okay, cool, thanks.
No, exactly. And again, you can raise sales invoices or quotes from these systems, which give you the ability to put PDF logos on, add pay it now buttons if you've got any sort of bank PayPal accounts or anything like that you want people to pay into, any sort of payment method. You can link it as a pay now button on the invoice. So again, you're just trying to take away any barriers, I guess, from delays in posting invoices out, delays in payment, ability to see if someone's read your invoice. Someone says to you, "Oh no, sorry, I haven't received that invoice." It's like, well, I know you have because you read it yesterday. It just, and you might not want to say that, but you know that. So when you send it for the second time, you just know whether they're trustworthy or not. So it just gives you a little bit more information. And a lot of the cloud accounting softwares, and particularly Xero, has other apps that can work with it that just make processing purchase invoices as well really efficient. So there's an app called Dex that we recommend to a lot of clients, and that's any PDF invoices or ones that come across on email or you can scan. They can go straight into the app. Say your supplier or fuel goes to this code on the accounting system, it will automatically process SO to fuel every single time you put an SO invoice in. So again, it just streamlines it and gives you an ability to manage your purchases and make sure they're going to consistently the right place without any form of manual entry. And for me, I think on the basis that a client's told me they've got to pay quite a lot of money to have a shredder for the last 19 years of accounts information that they've got in files, it's really handy to be able to have this stuff online and not have to have loads of storage for accounting information.
Wow, okay. And in terms of, sorry, just sticking with the accountants, you mentioned another app. What was that? What was the app called? I didn't quite catch it.
Dext. That's
Dext.
DEXT. And that's a purchase invoice processing.
Right, okay.
And depending on the size of your business, there's an app called Approval Max, which is about sales and purchase invoice approvals. So for some companies, if invoices had to be passed around, previously we would have taken a bit of paper, you'd have put it on someone's desk, waited for them to be in, sign it off and pass it to the next desk. Effectively, some of these apps take that process and put it online. So It means, again, it's the type of thing that if you're in, sitting on the train or you've got a bit of downtime, you can go and approve certain things. So the bigger you are, the advantage of the cloud softwares is you can get some other bolt-ons that, again, are all relatively inexpensive, but just really streamline the processes for a business. And it's more about being on the go.
And just out of interest, I mean, obviously there's a number of packages now. I mean, you go for Xero. We recommend Xero, but there's some franchisees that are on Sage. Now, whether they're on Sage Online, I'm not sure. But do all cloud-based accounting packages do exactly the same? Or, why do you prefer Xero over, say, Sage, for example?
Yeah, no, that's a really good question. So the reason we prefer Xero is actually there were some really good desktop accounting systems, but they were really built for accountants. So Sage and QuickBooks, their desktop versions, they were good to use, but they were built for accountants. So it made it quite difficult for you as a business owner if you've not got any form of finance qualification to learn how to use these things. And I think that's why they were treated as these are the tools for the accountants to make my year end cheaper. The reason we prefer Xero as a cloud-based is they have looked at improving the desktops, but making the functionality much more usable for the owner manager.
Right.
But it's still got the level of sophistication that some of the desktops had. Whereas Sage and QuickBooks cloud versions are a cheaper version. They're not as good in terms of their reporting functionality or just how you use it for a business to sort of do payment runs and payroll journals and things like that. So Xero have almost looked at all the good things that the desktop did, turned it into owner managed language, and remained as a sophisticated accounts package for the purposes of using it.
Okay.
So that's why we would prefer it, because although the others are similar, they're all similar in price, it's not the same quality you're getting.
Okay. All right, thanks.
Yeah. So I thought before we talk about sort of costs in your business, I thought I'd talk about building value in your business and really the definition between a lifestyle company and a business for sale. So I don't know if anyone's ever heard of those definitions, but if I explain them a little bit. So a lifestyle company tends to be a little bit more tax efficient in terms of there's quite a lot of costs in there that maybe a slight grey area, or we've added the wife on and her car goes through there, but she's never been in the business. That's almost like a lifestyle company. You're using it to generate an income, but also tax efficiencies. But then you're kind of at the same level. You don't need lending. You're not looking to grow particularly. You are looking to draw the money out of the business every month. There's no real investment in equipment as such. Now, obviously, if you were then to flip that and look at, right, well, is that a sellable business, I guess? Absolutely. There'll be some key fundamental things that business is doing that has value. The difficulty with that type of business is, how do you demonstrate when you're not making much profit to someone it is a business worth buying? And quite often with lifestyle businesses, there's sort of small, maybe some personal costs or tax efficient costs all over the profit and loss report. So it's really hard to pick out the things to say to someone, well, if you bought it, you might not do this, and this is how much money I'm making. So a business for sale is really designed to demonstrate the strong gross profit and the net profit position. So that's not to say a lifestyle company is bad. It just means that if you are thinking of selling your business, you have to appreciate that either you need to have a couple of years to plan, like the switch of financial treatments, I guess, or that you will get less in terms of value in the way of sale, and you might not get the sales structure that you wanted. So for most people, it's more tax efficient for someone to buy your shares out of the company than buy your trading assets. But obviously, if you've been a lifestyle company, if someone was to audit your books as part of a potential purchase, they might be uncomfortable with some of the decisions you've made. And with a share purchase, we call it a warts and all transaction, where you are buying all the history. So obviously, if it's been a lifestyle company, if someone was saying to me, should I buy it? I'd say I'd buy the trading assets, because then you just don't get the history. You get a fresh, clean company. So it's just they're the sorts of things that's worth bearing in mind. I wouldn't say one is better than the other, but just depending on what your strategy is and what you want to do with your business. But this is what we work with clients quite a bit on, is having a clear understanding of short-term goals and long-term goals, because sometimes they need to, if exit is on the horizon in 5 years, there's a point where we would need to transition what we're doing.
Yeah. And it's interesting, we use the term, kind of minimizing your tax liability. I like the term lifestyle company, actually. And again, as the franchisor, we don't have a problem with that. It's the franchisee's business, and it's up to them what they do with it, provided it's all legal. But minimizing the tax liabilities is fine. But yeah, if you need to then change it for into a business for sale, you really do need to make that transition, don't you?
Yeah, absolutely.
Yeah,
And plenty of accountants, I suppose, wouldn't like that. I'm a bit like you. I'm a bit more practical, and I feel like running a business, you work a lot of hours. There have got to be benefits. It's just about tracking and knowing, and knowing things. And I suppose the danger with having a lot of personal costs in the company is it makes it quite hard for you to read the actual profitability of business versus maybe where some of the spending is going on.
Yeah, certainly in previous, I've been involved in valuing businesses previously, and that sometimes is when you're doing that adjusted EBITDA, it becomes a bit of a challenge actually picking out where those adjustments can be made. So yeah, interesting. We've had a couple of questions that have come in, one from Peter and another one relating to Xero. Should we carry on and then come back to them, do you think? Probably flow easier.
If that's all right. Yeah. If that's okay. I won't ignore your questions.
No, we'll pick them up. Yeah, perfect. Okay. Sorry, Emma, you carry on.
No, that's all right. So in terms of, we were talking there about costs. So as part of your finances, it's really important to get your costs correctly defined on your accounts. And over my years as an accountant, I've seen all sorts of things. I thought I'd just explain the definition between cost of sales, direct costs and overheads. So cost of sales are costs that are directly linked to your purchases. So for example, in your industry, that's materials and labour. They're the two things that you think, yeah, absolutely. Your X amount of labour hours for that sales invoice and X amount of materials. That's really clear that they are separate. So direct costs would be things that they're not directly linked to every pound of sale, but they are impacted much more significantly by sales. So probably my best example of that would be equipment hire. So, if you're having to hire equipment to do the work, maybe that's a cutter or something like that. It can do X amount of pounds of sale, but once you go above that, you might need another one. So those type of costs, they go in tranches, but they need to be built into your costing because it's all part of delivering the sale. Because obviously if you had no sales, you'd cancel some of those hires. Whereas your overheads, it tends to be it's much harder to cut those back quickly. You're kind of stuck with your overheads. That's things like your office, regardless of whether you're £1 of sales or £100,000 of sales, your office costs are your office costs.
And Emma, sorry, in terms of direct costs then, is that, so would I be right in saying that cost of sales and direct costs go straight immediately below your sale, your turnover, and that impacts your gross profit margin?
You can actually set it out in two ways. You can set it out where your cost of sales, and then you have a margin after cost of sales, and direct cost. So direct cost is a separate section. Right. Okay. Fine. But the good thing is that they're separate to overheads.
Yes. Yeah. Of course.
Yeah. So again, when you're looking at them, it's often the things that you need to cost into a job, but it's hard to just allocate them job by job.
I think a lot of franchisees, I might be wrong, but a lot of franchisees I think would just have that one cost of sales and put some of those direct costs that you've talked about, they would just put them into cost of sales. I know a couple of franchisees put a lot more stuff into cost of sales actually, which is, we would argue that maybe they should be sitting in overheads. But I take your point around that, having them split out and seeing the differences.
And the reason I think it's so important to get right is because then your profit and loss should be a reflection tool on the business and the margins and the costing. So you suddenly see a reduction in gross margin, you know what to look at. Right, are you pricing labour correctly in your proposals? Are you pricing your materials properly? Have you got a wastage of materials problem? I've had it before in businesses where scrap metal was worth quite a lot of money. Scrap metal went walkabouts, but we picked it up because they had very clear costs of sales. So we knew something was going wrong and we could drill down. I think when it's all a bit murky, you lose focus on the bits you can control quite easily. You don't get the opportunity to necessarily consider that line item of how you cost jobs. And also,
Sure.
I think particularly for your franchisees, I mean, they've got a bit of an opportunity here to gain benchmarking with your help across the franchises, which benchmarking information is really valuable, but obviously it would need people to be doing things in a reasonably unified way. But that benchmarking, I mean, the amount of companies ask me for benchmarking, and then you end up having to find a benchmarking company who just do it based on companies' house codes. So it's not great. Whereas the advantage here is obviously you can talk to other franchisees and see what people are dealing with, really, and learn best practice.
Sure. Yeah. It's one of the advantages of being in a network like this, I guess, if we got that information. Yeah. Okay.
Yeah, absolutely. I mean, I am a numbers nerd, so I appreciate you guys might not love numbers as much as me. But all right, excellent. Well, so often people say to me, so like, what are management accounts? I think accountants talk about them. People don't necessarily understand what they are or the importance of them. So I've popped a bit of a basic example on the screen. And that is a reflection of, if I was to print a profit and loss report from your accounting system. So you've put all the information in there. Purchase invoices are just at the date the purchase invoice is dated. That's all in there. Just to demonstrate, you can see if you don't have management accounts produced or know how to do them yourself, how wildly different months can look just because of timing of invoices. So obviously this example, if I was to look at January or March, I might think, oh, I've got loads of money. I can take some extra money out of the business here. This is brilliant. Buy that car, book that holiday, you know, I'm on a roll. But if you were to look at February just as one month, you might be thinking, oh, hold on here, let's send or cancel that purchase order and sack someone, because it looks dire. But obviously, if you look at the averages look good. You know, they're strong and consistent profitability. But the difference here is obviously you can see that February had a really bumper purchase month. There's no stock adjustment. So you're not actually getting any idea of what money you made from the £100,000 of sales in February because of the stock adjustment. It's not, you know, stock isn't there. The same as work in progress. So what would happen with work in progress is quite often you buy things for jobs before they start. And if that happens to be overrun a month, you might have costs in one month and the invoice in the next month. So what work in progress does is it basically helps you pick up those costs and move them into the month where the sales invoice is. So you're sort of matching the costs with the invoice timing. And the same goes for overheads. You know, you can get that in overheads. I know quite a lot of overheads are paid on direct debit, but things like rent and insurance often come out in either quarterly chunks or annually. And it just fluctuates your bottom line. So what management accounts would do is make those small sort of 10% adjustments to turn the information from your accounting system into something significantly more valuable to you as a business owner. And then I'd also be looking to do things like building your tax provision, so you're aware of what your taxes should be. Consider a dilapidation provision. So for a lot of you, if you're in commercial property, you've probably got a full repairing lease. And one of the things I would always expect is that maybe when you first move in there, you consider how long you might be in the property, you consider maybe how much you think a provision should be, and just slowly put a little provision through as cost in your profit and loss. So you're not losing the cash necessarily, but we are providing for it. So it shows that it's not profit available to draw, which again, I think it just means that you don't get some big shock if you come to change premises. And then, so a big one for me is directors' dividends. So I would expect that a lot of you are told to take a minimum salary. And I'm sure if that was your actual salary, you'd cry. So that's £700 to £1,000 a month. I'm sure you will work much harder than that. But because you take your dividends, because that's the most tax efficient way to take your money. But obviously, if you're looking at your profit and loss, particularly for the purposes of valuing your business in the future, one of the things I did on a recent valuation for a potential franchisee was to look at the cost to replace yourself as almost like the job element that you do. So building those regular dividends in, quite often people set a dividend limit based on what they would have earned as PAYE salary, or they think they should earn in the job, and put those in as a cost line on the profit and loss. And then you can see if you're making enough money every month to cover the money that you consider to be a required minimum. So that's what I call a real break-even point. I think a lot of people look at break-even, it's like, oh, you know, they kind of forget that actually as an owner manager, what you're paying yourself is sometimes the most, you know, I'll say the most important, but, you know, it's pretty important, isn't it? If you've invested all blood, sweat and tears into a business, and if you were consistently not meeting that, then you've got to make decisions about some of your other overheads potentially, or have a conversation. So building that in is, again, just gives you a much clearer picture of the business. And then, because we work with a lot of owner managers, we know that you guys, what you draw monthly is seen as your net of net, and you don't necessarily put money aside for the dividend tax that is payable. So when it comes to sort of January and July tax payment time, you need to take an additional amount of money. Well, if that's the case, again, we just help accrue. I'd always recommend accruing the dividend tax into the profit and loss, so that you've got a clear picture of residual profit. So residual profit after tax, after dilapidation provision, after directors' dividends, and after directors' tax savings, effectively. The reason for that is that gives you an idea of what a third party would earn as an owner of the business, even if they weren't doing the job element. But also you've got an idea then about what you've got to either draw additionally, or more importantly, invest in growth. So I just thought it was quite handy to go through an example of what is the importance of management accounts, because you'll have heard accountants bang on about it, and sometimes we don't necessarily explain the importance of the adjustments. And when I say importance, they're importance for you as a business owner. You need this stuff to make sense, otherwise it's just pointless. So monthly management information is, I think, is pretty critical. I do know people that find monthly too much. Quarterly is a minimum, I would say. Quarterly is an absolute minimum, but monthly is the best thing you can do. And the timing of the reports is critical. So obviously, the nearer the month end, you get the information. So, you know, getting a report on the 5th of March, say for February, is much more valuable to you than it is if you get it on the 20th. Because you know, it's all fresh in your head, you know what's going on, you can turn some stones and see if there's any problems you need to look at, or just focus on what you need to do next month. So there's all sorts of reports you can run from your account system. And I know one of the things Mike and Hayley have said about before is how a lot of you guys, when you get into the franchise, you do a budget and a cash flow of what you're expecting. Now, a lot of these packages, you can put those in as budgets, and you can monitor actual to budgets, which is really, really useful. You know, really, it just gives you an idea, but a steer about if you're on course or not. And another one of my favorites is as a prior year report. Not all softwares do it. Xero, I've built my report for this, and it shows you like for like in terms of months. So obviously, if you were looking at January versus February, January is often a sort of nearly a 5-week month. February is a really short month. They can look very different. And then I think sometimes you'd feel a bit deflated by, oh, well, February wasn't 100,000 and January was, but there were more working days in January. So I always like the prior year. So it's February compared to February. And then any seasonal trends, which I think a lot of businesses feel it's a little bit slow over summer holiday time. It's certainly a bit slower over December and January because of everyone winding down for Christmas and gearing up for the new year. So you can see how you've performed compared to the year before. So again, it just gives you a way of tracking if you think there's a downturn or a problem without it being a seasonal valuation that makes you panic. And using these reports, you're really trying to keep your handle on gross profit margin and pricing. You know, they are the things that are probably easiest, I say easiest to control. You can influence the quickest, but it just gives you that data. And then we have a very quick 5-minute cash flow tool that we use with a lot of our clients that you can download from our website, which is like a snapshot of cash flow. Obviously, my recommendation would always be to do a full cash flow, but if you need to do it quickly, the 5-minute cash flow tool, and it gives you a little bit of time to work in the full one. So I would tend to run this for a lot of my clients who don't monitor their own cash flow on kind of a monthly basis to get a bit of a pattern of cash flow. Again, it's knowing what you need to worry about. You know, if August is a low cash flow month, and it's always a low cash flow month every year, you don't want to get caught out. So the more data you have to refer to, the better. And this just takes you through all the money that's available to the business, including the overdraft. So that's the cash you've got. And then we look at what are your liabilities accruing, because your company tax bill is obviously payable quite considerably after the year end. Your VAT's paid quarterly, rent sometimes quarterly, insurance sometimes 12 months. So this gives you an idea of, in an ideal world, how much money should you have set aside for the costs you've got coming up, you know, those big ones. And then if there's any other maybe arrears that you need to catch up with. So that shows that actually there's a shortfall in cash for this business. Now, the idea of this tool is not for you to panic. It is for you to know that's what it is, and for you to be able to assess it in the next week, month, regularly assessing it. Obviously, the nearer you get to the things that are payable 12 monthly, like your corporation tax bill, if that starts getting bigger and bigger towards a large payment, these are just to give you early indicators that you need to do something. Because I think sometimes it's going to try and avoid it and hope it goes away. And the delay, what it does is it limits your choices. That's what I would say. I would say, you know, when cash gets really tight and you suddenly need cash, it limits where you can get it from. Because any lender now, I think particularly because of COVID, lending decisions are taking a little bit longer. And you can just plan it. You can work with people to delay it.
I suppose if that number keeps getting bigger and the months to go get smaller, you do need to panic then, don't you, I suppose?
yeah, absolutely. But I suppose the key is finding the point where it's like, I've got time to work out what to do. And
what can I do about it?
Yeah, and what can I do about it? You know, is there things I can do? Yeah. And have an important conversation before you end up in a situation where it was due, you don't pay it, HMRC send a debt collector out. And if they send a debt collector to your place of business, it can be quite damaging. And that's not necessarily just for your customers that are there. Your staff see a HMRC inspector coming in, a debt collector, they will panic that their job's not secure. I guarantee you it's lost employees before. I know it has with clients, because I know I've had to do emails to staff bases to say, don't worry, it was because sometimes HMRC do make mistakes, you know. So we have had to do a little, hello staff, this is the accountant here, nothing to worry about, you know. Yeah, so just I always think the earlier the better. You just get to have good conversations.
It's the old adage, knowledge is power, isn't it? If you've got your finger on the pulse, you're that much more able to do something about it. Yeah.
Yes, yeah. And I think the thing that has been really made clear over the last couple of years is there are so many things you could worry about running a business. You know, it's a bit lonely being an owner manager. There are so many things you could worry about. And if you don't have the financial data, you don't know which of them it is. So you worry about them all and you lose sleep, and that's not productive. And so actually, if you know, I think focused worrying is much more productive, isn't it? Like, we all know that. And so the last thing I would talk to you about is when you're at a point where you're thinking, actually, I've built the business a bit. There's always a point where I'm sure you are working a lot of hours, and something needs to give, or you need to start building out your team and your processes. So we've talked about automation. I've talked about automation in finance. There will be other things that you can automate within your industry. There always is, but quite often the finances help run the business. So we always look at streamlining those as much as possible. And then we would talk to you about how you design job roles and responsibilities, because you running a business, you're head of sales, you're head of marketing, you're head of finance, you're head of office, you're head of operations, you're also working on the job, and you're head of complaints and customer services. It's exhausting chopping and changing like that all the time. If you start building out a team of people, and that doesn't have, I'm not talking about necessarily has to be full-time people, you can outsource some things, but as you design like job roles, that can be quite hard to start thinking, well, what is it I'm looking for? What do I need help with to help free me up to do the things that I guess earn the most return, pound per hour type thing? Because obviously, if you're out getting the tea and coffee for your office, that's probably your lowest pound per hour return compared to if you're signing a new client. So it's all about trying to shift some of those, the lower value tasks, and give you more time at the top. So my little tip on roles and responsibilities is, get a big pack of Post-its over a week, just jot down each of the tasks that you do, from buying the milk, turning the alarm off, sending out a mail shot, whatever it is, pop them all on a wall. And then the reason I do Post-its is it means you can move them around. Start thinking of them in sort of columns where you think, right, this is sales, this is marketing, this is operations, this is finance. You try and move the tasks into sort of lowest level in those things to highest. And then you start looking them across the roles, and you might think, oh, actually, I probably could do with 2 hours of admin and an hour of finance and a little bit of marketing. You can start then putting a bit of time on those Post-its about how long things take, and it's much easier to see what you might need or how you might be able to split up what you need. Because quite often, I don't know about if you find this, Mike, I think quite often people think, I need a whole person. And you might not. You might need so many hours of this, so many hours of that. Or, maybe you do need a more general intern. And that's how you then design the job role and explain it to someone. But it's also then how you manage them when they're working for you, because that makes it a less emotional conversation from, I don't think you're quite doing what I need, to, these are the things I need you to do. Here are the 3 things out of that you're not doing.
It's really interesting. I call that a brown paper exercise, where we used to put brown wrapping paper, stick it on the wall, and then stick the Post-it notes on top of it, and then start to do that. I didn't do what you've just said, which is look at it horizontally. If you're prioritizing the tasks, you look at it horizontally as well as vertically. That's really quite a useful thing, because you start to see what the number of priorities that you have, as well as who's best placed to actually do those things. Is there a set process for doing that? I mean, is there a document that we could send out which explains exactly how you do that Post-it exercise, or is that just something that you've done in kind of informally?
Yeah, I mean, it's just something I've done sort of informally with clients and given them a task. It normally comes off the back of, my wife's going to kill me if I work another Saturday.
Okay, yeah,
those type of conversations, or I've been working all holiday, holiday. You end up on your phone, don't you? And so just trying to work out how people leverage their time a little bit.
Sure.
And I think quite off, I'm having problems with a member of staff. It's not quite working the way I want it to. And I think without some defined roles and responsibilities, it feels like a personal attack, because it's like, you're not doing what I need you to do. Yeah. And that, that I think that would feel like a personal attack. You'd be like, well, to me, I think I'm doing everything you need and more, and I'm doing it well.
Yeah.
But actually, and that's, it differs, doesn't it? But it's just, staffing and labour supply is always a bit difficult, and it's certainly, I think, where there is a bit of a labour shortage in the UK. So this is how you try and leverage that really with some of the lower tasks. And if you've got more senior people, how you maybe get them to do more of the more senior tasks and take away some of the basic stuff, just so that you can keep that person and you can grow what they can do for you without basically saying to them, you've got to work harder.
Yeah, I like that. I mean, we've used that approach. We've done a bit of work with the Stag Group, well, and with marketing, where we produced a marketing review, and we used that approach to kind of identify what all of the key elements are that we want to look at in marketing. And we're going to start doing it from a technical point of view, and also from a kind of general point of view, actually, with the Stag Group at the next meeting. So that's quite interesting. I'll pick up with you online separately to get a bit more detail in terms of how you do it, because be interesting to share stories on that.
Yeah, definitely.
Anyway, sorry, carry
definitely.
on.
And then obviously, no, that's fine. And then sort of trying to get some systems and processes in place. Now,
exactly.
They don't have, I always think to start, they don't have to be big, long processes. But if you're building a business, quite often, a lot of the knowledge on that business is in the owner manager's head. And then that's why it's so hard to bring people on as well. It's like, because I need them to do it my way. Because you do, don't you? You've learned over all this time how to do it the right way, how to get it right every time. You trust yourself, because no one's going to take care of your business like you do, because you've invested blood, sweat and tears into it. But how do you get people to do it your way? And systems and processes is definitely the way to do it. So I actually worked with a client who, so their business was supplying coffee machines.
Okay.
Now, a member of staff changed, and suddenly they saw the turnover. So they also supplied the things for the coffee machines, all the filters, the beans. They noticed their sales of ingredients was dropping. And so they went into the warehouse and was like, what's going on here? Like, well, we don't really understand. We're talking to people. And then they saw a machine going out the door, and it hadn't got their sticker on it. So they used to have these stickers with, if you need to reorder, this is our contact number. And because of the change of staff, the owner manager will have trained the first person to do it their way, and they'd have remembered that. But it change of staff meant, the handover process between the two people, because the exiting person, do they care as much? Probably not. That got lost in the process. And so because the number wasn't really easy to find on the back of machines, their sales had dropped for the ingredients, which you can understand, can't you? Because what's the first thing we do if we can't find something? Hit on Google, or we go to Amazon, unfortunately. So what they did is they put a very simple checklist up on the wall, right by the door, that everything had to be ticked off before a machine was allowed out the building. And the last thing was the sticker needs to be on it. And the minute they started doing that, the sales went back up. So that just gives you a bit of an idea of trying to document some processes so people will do things in the way you need them to do it.
We, being a franchise, we have a franchise model. The challenge for us, of course, is trying to ensure that we encourage franchisees to be entrepreneurs and to try different things. But the ideal scenario is that we all stick to the model, because then you've got that ability you've got that transferability, if you like, and that kind of consistency across the piece. But it's an interesting story. That it's about kind of finding the right way of doing things and then making sure people do it right, sort of thing, isn't it?
That's it, yeah. And it's so hard. And I think particularly when you're building a business, because the knowledge is in your head, you haven't got that continuity then. And what what it generally means is there will need to be a longer handover, and also, it's quite at risk if anything was to happen to you.
Yeah.
And again, I think we all feel a bit more vulnerable now. So having that security that that the business can operate if you were unavailable for a period of time is very useful, because the last thing you'd want is that all your hard work being damaged.
And I suppose, so, I mean, we've been talking about building value in the business, and, it's making it more efficient, becoming more effective, if you like, managing your costs, managing the information that you have, which would in turn put some inherent value in the business. But I guess that this kind of approach is also, if you want to start thinking about growing the business, you need to do all of these things, don't you, in terms of understanding where you are now, how actually are you going to grow, and who's going to support you along the way, sort of thing.
Yeah,
Okay.
yeah, absolutely. So I work with quite a lot of clients, and we tend to, at a minimum, have a pre-year end meeting, which is often 6 to 8 weeks before the year end.
Okay.
Where one of the things we define is, what do you need to do with your business in the short and medium term? Now sometimes that's just about, does your business and your tax returns reflect what you need them to for the purposes of lending?
Sure.
Because if you're working really hard in your business and then you can't get you can't move or get the borrowing and things you need, that's a real problem, and that hurts. And so, as I said, tax efficient set of accounts looks very different to that you might present to a lender.
We've got a couple of questions that have come in. We've got a few questions. Can we deal with those questions, do you think, now? Is that?
Yeah, absolutely. So I've just popped there. It just gives you an idea of some of the things we work on with clients. So we do help clients with scoping documents and looking at automation. Quite often that's off the back of, we've just lost our finance lady, what do? We can't find anyone that is willing to work for what we need. And then we will look at the automation of processes. Our 5-minute cash flow tool is available on our website. We do a strategic business review meeting for people. And also, for a percentage of our clients, we act as a virtual FD, where it's our responsibility to do management accounts and then present them as if we're part of the team. And obviously that's quite cost efficient for a business compared to, the cost of actually engaging a financial director.
Okay, cool. Okay, that was good. Thanks for that.
So I'll stop sharing my screens now and we can crack on with our questions.
Yeah, okay. So we've got a couple of questions from Peter. The most relevant one, actually, the most at the minute, is how far out should you switch from you mentioned lifestyle business and business for sale, if you like. How far out should you switch from a lifestyle business to a business for sale?
Yeah, so to give you an example, if we were looking at a valuation, part of what we do is we use a number of different business models, but we would assess the last 2 complete financial years plus management information, or if we're right on the year end, 3 years financial information.
Yeah.
And look at an average of those profits.
Yeah.
So.
And that's the norm across franchising as well, actually. In all any valuations I've ever done, we've always looked at the last 3 years, full 3 years accounts, and made the adjustments, and maybe taken an average, take account of the trending in the business as well. But yeah, 3 years, I think, is, yeah. Okay, thanks for that. Let's have a look. So going back to Xero and accounting, so reference the bank feed. How is the received payment in automatically assigned to a particular invoice?
Yeah, so Xero uses sort of artificial intelligence to spot certain things. So it might look at surnames, or if there's an invoice reference. And what it will do is it won't automatically match it because it might be wrong. It basically comes up to say, we think this is this. And then it's got a little box that you tick to say, yeah, I'm happy with that.
Got it.
Yeah, so it's really clever, and they're working on that that technology all the time.
Okay, good. Thanks for that. still sticking with kind of Xero and good practice, what's the best way of chasing debts stroke bad debts? You referenced kind of weekly and monthly calls. I guess that's the first part of the process.
Yeah,
Avoidance
absolutely.
is better than
yeah, I mean, it's having a almost like a process chain for your debtors. You know,
yeah.
we do first chase on this, we do second chase on this. This is when I need to do something different. So with Xero and some of the other software, so you can get credit like chaser apps that you can set. And this, I love this. Sometimes you can set them to say almost like remind a few days before it's due. So you can design the email. So it's a very polite. I'm going to take Peter's name, for example. Hi, it's Peter. Just to remind you, this invoice is due for payment in 3 days. You know, really lovely. And so that's almost your first chase. And some of the technology you can automate. Then obviously, once it's past a certain point of the payment date, you'd say, right, you know, hi, you know, it's me again. This invoice was due for payment Friday. Please can you ensure that it's in the account within 48 hours or whatever you want to say. So I wouldn't do more than 2 chases on email. Then I would pick up the phone and again, you know, hi, it's me. You know, these were the agreed terms. I need you to settle that invoice.
Yeah.
If you obviously get past the point where you think this is uncomfortable now, so this is why I would have a set process for it, because then you can warn people as well. If this isn't paid within the next 5 days, you know, you're already 15 days late, say, or 30 days late. It's not paid. I'm going to have no choice but to escalate this.
Yeah.
And so then I would send a letter out in print, but I'd take the logo off or change the formatting of your stern chase and make it look more like a debtor chase. If you've ever seen a debtor chase, they have a big black box where they have this is the debt, and it might be if you've got interest or anything that is part of your terms and conditions that can be charged, maybe you put that on there and say this is, and plus court fees if you were to go to court, this is, you know, this is what's due. If you don't make the top payment within so many days of this letter, we will be forced to move this on. The reason you do that is you try and just change the tone and make it look a little bit more like it's an external letter, because you want them to think, oh, that's potentially come from a solicitor.
Yeah. Okay.
Obviously, then you can either engage a solicitor or a debt chasing agency.
Yeah.
But I think, again, it's just making the point that you've got, these are the terms, just re-clarify what your terms and conditions were, what the costs are of not following it. But it is about being consistent with that, because the longer you leave it, the more people are like, well, you obviously didn't need the money.
So we're getting a couple of questions going into the chat room as well. So let's have a look. So, oh, hang on, I've lost chat. Where's chat gone? There it is. So what's a reason? So sticking with debt. So what's a reasonable time between the invoice due date and a plan of action letter? I guess it does depend on the terms to a certain extent, to a large extent, and then kind of what 5 days. Well, I suppose the email could go a day afterwards, and then maybe the second email 5 days afterwards, a call 5 days after that. Does that sound kind of reasonable?
Yeah, absolutely. I think what you want to prove is that you will uphold your terms and conditions.
Yeah.
Because if if they were due to pay it on a certain date, if you're chasing them the next day, or maybe 2 days after that, because it's not, you're on it. They know you're on it.
Yeah.
And the same with, and that's why consistency is key, because then you're saying, and this will be the next, this will be the next point, and this is when it escalates. And
is there a reasonable time to, kind of really go formal then? It becomes a bad debt. I mean, what do you have a definition of what is a bad debt then, where you might hand it over to an agency or raise a claim or whatever? Do you have a sense of that?
Yeah, I mean, certainly over 90 days, I think you're in danger territory of not getting your money.
Okay, 90 days plus. All right, thanks for that. I'm going to try and rattle through these questions. There's some really good questions. So So Jamie has said we use HubDoc on Xero. Is this similar to the app that you mentioned?
Yes. Yeah,
Okay.
absolutely. I think the difference in the one we mentioned is it's got a find and fetch function that some of the bigger wholesalers and suppliers, and you can actually type in your account details and they'll fetch the invoice, which is like, I mean, feels super lazy, doesn't it? Like, you know, putting in your, say, for example, BT login, and then it goes to get your bills rather than you even having to be sent them. But that's
efficiency,
but,
isn't it?
but it's exactly. Yeah, it's one less job, isn't it? But yes, HubDoc is very similar.
Knowing some of the franchisees, what form of this might be a big answer actually. Knowing some of the franchisees, what form of automation would you recommend?
So anything where you can streamline inputting. I think the important point I would make is what you want to try and avoid is data being entered in too many locations. So what you don't want is customer data in 2 or 3 different areas. You know, you want to use certain things. That is where you go to for that information. So really looking at all your processes to see, right, where are your entry points and how can you streamline that? Certainly your sales order processing to invoice, that's, you know, really try and automate that by setting up some standard text.
Okay. We've got one. Would you, going back to this, is there any, I think we know the answer to this. Is there any, what's the benefit of switching from Xero to Sage? From Sage to Xero, sorry.
Yeah, so the main benefit is the automation.
And is it easy to, and
Sage
also
is quite
how easy
expensive.
is it to transfer?
Yeah, so Sage can be quite expensive in terms of desktop and stuff now. You know, it can be the equivalent of a few £100 a month compared to maximum of sort of £30 a month.
Okay.
And Sage is definitely better as a desktop version. So you just don't get that usability everywhere. To switch, you have a couple of options really, and depending on how clean and tidy your accounting data is, depends on how you do it. So if you feel that your accountant makes a lot of adjustments at year end, I would set up a fresh system on Xero and just put the opening balances in. The cleanest time to do that is, so if I was picking a point, I'd go year end is like the cleanest time. Then that quarter end, I would never ever change mid that quarter, never ever. It was just asking for trouble. But cleanest is year end. But it's just about planning the process and making sure if you're on top of your finances and you can really tidy up your year end quickly, obviously you can make the switch at the beginning.
Good. Okay, thanks for that. Just picking up. Would you recommend using a purchase order process?
Depends how many purchases you've got and what your process chain is, really, how many people need to see it. I mean, I wouldn't, you know, it's one of those things, isn't it? You've got to be a bit practical as well. I wouldn't add in a load of extra steps if you don't need to.
Sure.
But if you've got a process that you follow between passing paperwork between the team, and you know, it either doesn't quite work correctly or you feel like you're missing things, then yes, it would have a benefit.
Okay, I'm going to make a note of that because that's maybe a question we can have a look at. Would you recommend a cloud docs provider like DocuServe?
So I guess it's for what are you hoping to gain by using DocuServe? So with cloud accounting packages, you can generate your sales documents from there and link it all to it and use that as your storage. So, you know, with Xero, I would put things in there that sometimes aren't necessarily directly linked to a transaction. So I would always keep insurance documents in there as well. So I'd have a little folder that said, you know, vehicle. I might have my vehicle stuff in there. I might have my insurance stuff in there. Because again, if you were away doing a job, you don't want to have to ring someone to get out a folder if for any reason you need your vehicle information or your insurance information. It's nice to have that.
Isn't it? Yeah.
That ability to just access stuff.
Yeah.
I think now we're so used to everything being available from our phones. The minute it's not, you suddenly feel like someone's chopped your arm off, don't you?
Yeah. Okay. And then I think this is Jamie again. So he just said sales docs. I'm not quite sure what he means by that, but do you
Yeah, so
reckon it's
I guess it's where you want clients to access things from. So if you can attach them to the sales invoice, then I would tend to do it in the accounts package, because then it's all there.
Yes, yeah. Okay, I think that answers the question. Jamie, to answer your question, give us a thumbs up if it does, or a yes or a no. Yes, all right, thanks. Okay, I think I can't see any other questions. So we've got a recording of this. We can make it available afterwards. Everyone's got your contact details. If anybody wants to, got any specific questions they want to follow up with directly, either directly to Emma or come through me if you want to, feel free to do that. We've picked up some really useful stuff actually, which I think we might try and pursue further in terms of looking at, like, you know, what's the ideal purchase order process, and maybe get some views from some of the established franchisees and see if we can pull something together, because I think that could be quite useful. We do have a chart of accounts which we can make available to franchisees as well, but
yeah, and that's so handy to be given. That is perfect. Otherwise you can be stuck with a standard chartered account that comes with the accounts package that either you have to adapt or isn't quite what you need.
Sure, yeah. Good stuff. Emma, that was really, really useful. Thanks for that. I thoroughly enjoyed that. I hope, I'm sure the guys got some good benefit from that. What I would ask those people that have dialed in, if they've got any feedback, any observations or comments, we would welcome them. Perhaps you email them into me and I can collate them and feed that back directly to Emma after this session.
And thank you to you and Hayley for having me, and thanks for everyone that's attended. You know, I really enjoy talking about this stuff. You know, I enjoy helping businesses make it. Yeah,
you are quite passionate. Yeah. Good. No, it's been really good. Thanks for that. So I think we can call it a day. There's no more questions or comments have come in. So no, thanks ever so much to everyone that's dialed in, and we'll share these details out directly to you guys that have taken the time and trouble to log in. And yeah, we'll speak to you soon. Thanks again, Emma. Thanks, Amanda. You've kept it all going very smoothly in the background there. Thank you.
Thank you.
All right. Thanks, everyone.
Have a good evening, everyone. Bye.
Okay. Bye. Bye.